Hey, everybody, we are going to be talking about dividend stocks today, and specifically real estate stocks. But real estate investment trusts, a lot of people don't realize there are two very separate categories of them, and they're not really the same investment at all. So we like one, we don't really like the other one. Tyler Crowe is joining me today. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So I mentioned there are two different kinds of real estate investment trusts, or REITs. One are equity REITs, which are companies that buy physical properties for the most part. And then there are mortgage REITs, which are companies that invest in mortgages and mortgage-backed securities and things like that, um, and try to make money off interest rate spreads and things like that. So generally speaking, equity REITs pay lower dividends. Mortgage REITs pay higher dividends. That's why they're very attractive for a lot of investors. But they're two very different kinds of businesses. I'm going to talk about one equity REIT that's on my radar. Then we're both going to talk about mortgage REITs and why they're you know what you're getting into first. One in particular that has been really a turnaround story in my portfolio is a company called Outfront Media, ticker symbol OUT. They are a billboard REIT. If you're ever in a transit system like the DC Metro or something like that, and you see those big advertisements plastered on the walls, under it you might see Outfront Media or just Outfront or something like that. So they have two main areas of their business. There's billboards, which you'll see on the side of the roads, and then the transit system business. The billboards are by far the larger part of the business. And this company kind of got hit by a kind of double punch of negativity. Um, First was during the COVID pandemic. Obviously, no one was riding on transit systems at first. There were very few people on the roads driving because no one was going to work or anything like that. So companies really stopped paying for advertising in transit systems and on roadways. So then we started to recover from the COVID pandemic. Things were looking better. And then all of a sudden, the bear market of 2022 hit. The advertising business took a big hit because companies really pumped the brakes on their spending. Everyone was focusing on saving money and being more profitable and things like that, and not growth at all costs like we were seeing. So the advertising industry, although the world was generally getting back to normal, the advertising industry took another hit. So since that time, the business has recovered very nicely. Um, we, we're seeing revenue rise. Billboard revenue was up about 5% year over year in the most recent quarter without that much portfolio growth. This was all just kind of organic rent growth and things like that. Transit system revenue was up 7% year over year, also doing well. Um, it's been a while since one side or another of that business has not been doing well. Usually it's been like billboards are doing well, but transit systems suffering and things like that. You know, bottom line, the profitability is doing well. They're doing a great job of controlling expenses. The total expenses were up only 3%. I mentioned revenue was up by a little over 5%. The biggest rise in expense was actual posting of advertisements and maintaining them, which is where you want to be spending money. If you're an advertising company and you're spending more money putting up ads, that's a good thing. So the business is moving in the right direction. And looking forward, there's a lot of potential in digital advertising. You've probably seen digital billboards on the highway and things like that, but you probably have also noticed the majority are still not digitized. Digital billboards can bring in a lot more money than static billboards. They cost a lot more, as you would probably expect. You're essentially having a 50-foot LCD display on the side of the street that you have to maintain. It's a lot more than a giant piece of cardboard. Um, but when you listen to this stat, in Outfront's case, about 1,900 of their billboards are digital. That's about 5% of their total billboard inventory. Digital advertising makes up 1/3 of their revenue. So 5% of their billboards, 1/3 of their revenue is digital. They're investing a lot in digital advertising. They've added a bunch in transit systems, especially recently. They have a lot of liquidity for their size. The balance sheet's looking much better. Um, they're making so much money they actually just had to declare a special dividend in the fourth quarter, um, which actually brought their 2024 yield up to about 9% because REITs are required to pay out a certain amount of their income, and their regularly scheduled dividends were not enough They made too much money. It's a good problem to have. So out of home advertising remains a pretty big growth market. It's one of the few types of advertising that's not really disruptible by, podcast advertising and other things like that. It's not like print advertising where people can stop reading magazines. If there's a billboard on the side of the road, people are going to see it. So it's really tough to disrupt. A lot of growth tailwinds, especially in digital, like I said. So I still like Outfront for the long term. Uh, Tyler, we're going to talk about mortgage REITs. Tyler's going to kind of give you a quick overview of how they work and why you might want to be cautious.
Yeah, their mortgage REITs are a very tantalizing thing. When you're looking for something that's a high yield investment, you're almost undoubtedly going to come across mortgage REITs because typically you're going to see dividend yields above 10%. And it's like, wow, this is just too good to be true, right? Well, that's typically the case. Mortgage REITs, what they do is they buy mortgages or mortgage backed securities, depending on which company it is. The idea being is that the interest rate on its mortgages and mortgage-backed securities is going to be larger than the short-term debt that the company takes on to fund the purchase of these mortgages. It's, not to, it's credit or net interest rate spreads. It's the same way that, banks make a lot of money. It's the same way that a lot of other, financial companies make money. It's, lend at a higher rate and, and borrow at a lower. It should be very simple, right? Unfortunately, that just hasn't been the case for a lot of mortgage REITs because unlike banks, they don't have a lot of cheap capital sources to pay for what it's doing. Your banks, you have deposits and things like that. This low cost of capital, whereas mortgage REITs either have lots of debt, typically short-term treasuries or something like that, or it has equity. And remember that equity is got a very high dividend yield. I'm going to use AGNC Investment Corp as kind of the proxy here. They have a dividend yield right now of 14.8%. So when you have these high costs of capital, you have to go to the market sometimes to buy new securities and things like that. And so for a company like this, that either means taking on new debt or actually, and not or, uh, issuing debt, issuing equity. And like we said, equity is expensive. Debt's kind of expensive. It's certainly more expensive now than it used to be. And as a result, you get to this point where you have to make some tough choices. And that's kind of where we're at with a lot of mortgage REITs. Just to give an example, again, let's use AGNC Investment Corp. Even though its balance sheet has grown, if you look at the total equity of the company, starting 10 years ago, it had total equity in the business of $7.9 billion. Today, its total equity position is 9.6. So that sounds like it's grown, right? Well, yes and no, because it's grown, but you as the investor care about per share value, right? Not just the total growth. They have issued so much stock along the way to grow that equity pie because they needed to raise capital. The per share value has gone from $22.62 per share back in 2015 to $8.88 over the past 12 months. You've issued so much stock. The more stock you issue, the harder it is to pay your dividend because it means more money going out the door every quarter for dividends. And as a result, the dividend has been cut multiple times at AGNC Investment Corp over the past 10 years. Let me just make sure that I get the number right. Over the past 10 years, its dividend yield has gone down about 5.7%, which doesn't sound like much. But if we were to go back to, let's say like 2010, this was a company paying $1.20 per share. And today it's 12 cents per share on a quarterly basis. So it gives you an idea of like, it's an eroding sort of business. Like it has to issue extra shares which therefore puts a higher burden on the dividend, which eventually gets cut. Right now, it's paying out more that's coming in the door. It's actually having to issue some debt and equity to pay its dividend. And so it's probably likely that you're going to see another dividend cut with this company, AGNC. And that's probably the same thing that's going to happen with a lot of mortgage REITs because over the past 10, 15 years, that's just been the story. And I don't know what it's going to take to get that to change.
Yeah, I generally think that mortgage REITs are designed to do the best when interest rates are totally steady. That's when they are predictable. That's when they can figure out the spread and just kind of keep things, avoid having to raise more capital, like you were discussing. Um, and you mentioned the agency-backed mortgages, which is by far the more common type of mortgage REIT. There's Annaly Capital, it primarily invests in agency mortgages as well. That's NLY. You mentioned AGNC. They have lower risk to their loans. They don't really have default risk because those are government guaranteed mortgages. There are other mortgage REITs that specialize in things like commercial loans and fix and flip loans and things like that also have and they can take on less leverage, so they don't have as much or as much interest rate risk, but they have more credit risk in terms of loans that will default. Construction loans right now, for example, are paying 10 to 12% interest, and there's a reason they yield so much. It's because they're a riskier type of loan. So in bad economies, you could also see those kind of default rates spike and things like that. So the bottom line is there's a lot more risk to mortgage REITs than you might think, even with super safe assets like agency mortgages. It's really an interest rate risk type of concern. Tyler, do you own any mortgage REITs in your portfolio?
Never have.
No,
Don't now. I don't know if I ever will.
I have in the past in small, but I honestly, it didn't work out that well, and for the reasons that we've been discussing here. Um, I generally stick to the property owning REITs that are even if things are going wrong, they're more consistent businesses than mortgage REITs. So yeah, I generally tend to lean toward equity REITs instead of mortgage REITs. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investments. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.